I have two children, 9 and 7. They love motion pictures. And one that they've stumbled on recently, a series, is Back to the Future. You remember that. Michael J. Fox and a mad professor go back and forth in time, and they find some things different, but a lot of things the same. And that's sort of what I'm going to suggest has happened to Japan over the last year or two. To make the point that Japan is both returning to its 1990s situation and that it serves as an epitome for what's happening globally, there are 5 points I want to touch upon. The first, looking at 1990s Japan, trying to diagnose the illness. The second is looking at the global imbalances that we've faced over the last 5 to 10 years. The third is how the crisis itself unfolded. The fourth, the implications of that crisis for Japan. And then fifth, some of the lessons for the global economy that we can derive from that. And the conclusion I'm going to reach again is that, like Michael J. Fox, Japan is going back into a situation that it already recognizes is quite comfortable with, for better or worse. First point, what happened to Japan in the 1990s? We all know about the collapse of the bubble, and that was critically important, but there was something more fundamental going on before then, and that was demographic change. That from roughly 1985 onward, you had a very large proportion of the populace entering late middle age, the age at which people everywhere tend to earn the most and save the most. And all other things being equal, that means a country is going to have a very high savings rate, probably going to be running a significant current account surplus. And that is indeed what happened in Japan. Now, because of bad regulation and mistakes in the banking sector, there was a secondary effect of all this capital flowing into the economy, and that was that the bubble inflated in asset values. The collapse of that bubble in 1989-1990 caused corporate investment to start to fall off, and it revealed the underlying surplus of capital, the fact that the country was saving a lot more money than it really could use domestically. Now, normally in a situation like that, the answer would be that you export that capital. And in Japan, of course, we know that the country did export a lot of capital. The current account surplus was large, 3% of GDP, maybe 4%. I would argue, however, that if you look at the underlying financial behavior of households in the corporate sector, that economic textbook theory would say that that current account surplus should have been closer to 10% of GDP. I realize that's a stunning thing to say, but there are countries that have done that. Singapore, Switzerland, with similar demographics, have run current account surpluses near a tenth of GDP for many years. Now, in Japan's case, that couldn't happen because of the size of the economy and because of political pressure from outside. So what happened was the current account surplus wasn't allowed to get large enough to keep the economy growing by itself. And the implication of that, if you've got consumption weak and investment falling, and you can't expand net exports, there's only one section of the economy that can grow. It has to be, mathematically, government. So what we saw over the course of the 1990s was Japan doing what a country with excess savings and the inability to expand net exports must inevitably do if it wants to avoid depression, and that is to increase government spending and the national debt immensely. Now, the recovery that occurred from 2002 to 2007 occurred because the external demand improved. Essentially, you had the U.S. in a huge kind of bull market. You had China that had achieved enough mass, critical mass in the size of its economy, that it was able to suck in exports from the rest of Asia and indirectly from Japan as well as directly. And so essentially, Japan was able to substitute external demand for government demand. The government deficit came down somewhat, and the net exports increased, and the economy was able to grow more quickly than we had seen before. But again, what we saw is you start with a country with excess savings. The implication is either a very large current account surplus or a big increase in government spending. Japan explored both of those. Now, stepping aside from that for a second, let's look at the global situation over the last decade. There are two ways of looking at the global imbalances. One, the typical one, is to say that it was all driven by excess consumption in the United States, the UK, maybe Australia, a few other countries. That was for Nick Hope. Essentially, I would say that if you in this theory, of course, what happens is the United States is spending so much more than it earns that it has to borrow, and it is sucking in the capital exports from places like Japan, China, Germany, all the surplus countries. In that situation, the United States looks like the bad guy, the creditors look like the good guy, and that's the way you tell the story. If the United States would start acting more responsibly and cut its deficit, then the world would be a happy place. The other way of looking at the global imbalances, however, follows the principle that it's always best to follow the money. And here what I mean is most of the world for the last decade has been intent on saving a lot of money. There are three categories of countries. One is the aging countries like Japan, China, some of the EU, where people, again, the population has a large proportion that is entering late middle age and saves a lot. Therefore, those countries tend to run current account surpluses. Another category, and I think a more problematic one, is the developing world. According to economic theory, developing countries should be importing capital. They should be borrowing from abroad so that they can increase investment, raise their standards of living, increase consumption, ultimately keep GDP growing fast. Over the last decade, we haven't really seen that. And I would suggest that the reason is because the crises of the 1990s, the Mexico crisis in the middle of the decade, the 1997 Asia crisis, the 1998 Russia crisis, then came Argentina. There have been many, and they've been absolutely crippling to the countries that got caught in them. And part of the reason it's been crippling is they haven't gotten support from the IMF. In some instances they have, but often IMF prescription has been to put the country into a deep recession. This is, of course, the opposite of what the IMF was originally designed to do. And the lesson that countries took from these experiences was, if you get in trouble, you're not going to get help. So you have to insure yourself. So a lot of countries decided that they were going to run current account surpluses, amass money, save it as reserves, so that if they got in a crisis, they could solve their own problems. But the net effect of that is that what should be a global source of demand has become a global source of supply. Now, if you add to that the commodity exporters, who, as Michael said, did very well in the middle 2000s, you end up with a very large part of the world saving money, pouring excess capital into the global economy. And since that is the same thing as foregone purchases, it means that there's not enough demand globally. Now, viewed in this way, the United States, the UK, Spain, Australia, some of these other countries that tend to spend a lot have actually been doing the world a service. They've been providing the demand necessary to keep the economy growing. So schematically, you can kind of divide the world into two economies. There's the United States, which spends more than it earns. There's the rest of the world, which earns more than it spends. Interlocking weaknesses, none of them really normatively better than the other. Now, next point, the crisis. Because of 20 years of deregulation, financial innovation, we've seen the leverage ratio in a lot of different economies go sky high. And I would say that we can view that as all this money from the rest of the world flowing into financial markets being increased, magnified by the increase in leverage around the world. And then that money has to go somewhere. And it tended to go into the most liberal markets of size, meaning the real estate market in the United States, the UK, Australia, go through the same story. There, people took the money that they earned because of appreciation in their homes, used that to finance consumption, which provided the demand for the rest of the world. Now, that bubble, the bubble in financial assets, and particularly real estate markets around the world, started with the U.S. subprime. It imploded when the U.S. subprime market got into trouble. And that started a process of deleveraging, which has done immense damage. I would say that one reason for a caution is that that process is not over. It will probably take another year and a half before leverage ratios are down where they should be. And that's a deeply recessionary pressure. But there's another element, and that's the way that the crisis has interfered with or helped resolve the global imbalances, essentially by knocking out U.S. consumption. As Michael said, the savings rate in the United States has gone from 0 or 1% up to about 5%. That is a direct loss of demand for the rest of the economy globally. And what we see is that the U.S. trade deficit, which was the engine of global growth, has been knocked out. My guess is going forward it will probably be half what it was, meaning that the equivalent of 3%, 2 to 3% of U.S. GDP has been lost in global demand around the world. And the point is, again, that if you start with a situation like Japan in the 1990s, where there's excess savings, then there are only two ways forward. One is by increasing exports to the United States, ultimately. The other is by increasing government spending. Point 4, the impact of the crisis on Japan. Japan never left the 1990s. It still has excess savings. Now, the nature of that has changed a little bit. Instead of households, it's largely corporations that are producing the excess savings. But there's still excess savings. The implication is Japan, to grow, still needs either a big increase in net exports or a big increase in government spending. The 2002 to 2007 recovery was a period during which excess or increases in net exports was the key. Going forward, because the net exports are gone, the growth in net exports is gone, we're going to see Japan shift back to government spending. Trade, because of the collapse in U.S. demand, fell by about 40% year over year. Industrial production is down by a third. Unemployment is going up. There is not going to be an increase in domestic private sector demand. What that means is that the government budget deficit is going to expand really dramatically. Now, in concrete terms, what does that mean? It means this year, Japan's GDP will probably shrink by 6 to 7%. It will improve thereafter. In fact, it already probably is. My guess is the third and fourth quarters have positive numbers. But there is a danger that the economy falls back into recession next year because once the government stimulus falls out, then Japan again has inadequate demand. And over the longer term, I think Japan's growth rate is going to fall back towards about 1.2%. Now, point 5, the global insights. I'm describing the U.S. or the global economy much like Japan. A system where almost all the world is saving more than they should. That means that there has to be a source of demand. The U.S. was that source of demand. Now, since the U.S. current account deficit is going to fall by about half, the rest of the world is lacking demand. The implication of that is, again like Japan, that the only way forward is a big increase in government spending. And we see that in the United States, where the deficit this year will be 13, 14% of GDP. We see it in the UK. We see it in Japan, even China. It's pretty much a global phenomenon. And that, again, is the implication of having a collapse in net exports. Now, what does it mean going forward? And here I probably differ from Michael a little bit. I think that we're going to see this dependence on government spending persist longer than a lot of people do, because I don't see where the demand's going to come from. The alternative really has to be, it's got to be consumption somewhere around the world. It's not going to be Japan. It's not going to be China. Probably won't be Germany. Should be the developing world, and yet, as we've seen, they have reasons for being nervous about this. So the global outlook, depends how you want to look at this, but in purchasing power parity terms, this year I think GDP globally falls by 1.8%. Next year it will rise by 2%, but then it'll take a few years before it gets up to about 4%. And that's lower than it's been. So my guess is that for a decade or so, we'll probably have lost 25% of the growth we've been used to. So the conclusion, Japan escaped its stagnation during the surge of 2002 to 2007. But that demand is gone now, so Japan is again dependent on government spending. The same thing is true globally, and I think it's going to last until we can persuade people somewhere else to start spending more. I would really focus a lot of attention on what's necessary to make developing world countries comfortable with the exchange rate system and the IMF, because that really does have to be a source of demand globally. Until then, I think we're stuck with a smaller version of the global imbalances, meaning the U.S. is still borrowing money, other countries are still lending money, but also with a long-term increase in the importance of government relative to economies everywhere.